Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Let's talk about an important data point that came out today, ISM manufacturing. So ISM manufacturing came out a little bit worse than expected, weaker than expected. And you got different components as well, like the employment component, which came in a little bit weaker than the previous month, the orders component, which I believe a little bit stronger than the previous month. However, the prices component, which is really important in today's context because we care about inflation, that came in hotter than expected, higher than expected. So the reaction in the equity markets was that you've got ISM manufacturing that gives you kind of the growth story, how the manufacturing business is doing within the United States of America. Are they growing? Are they expanding? Are they not? Is there a contraction happening? And we saw that the number is slightly lower than the expected, which is telling you that the growth story in the manufacturing side is not doing so hot. Now, that caused a little bit of a rally in bonds and stocks initially on that move. So we were happy that, okay, weakness in the economy, not so weak, but some weakness, which basically, why would, stocks and bonds go up on that? The reason would be that the idea that the Fed wouldn't hike as aggressively because, if you got a weak economy, you shouldn't be hiking. However, that quickly flipped and that quickly turned around. We saw bonds completely sell off and went up a little bit. You had a couple of squeezes and then bonds continued to really sell off. And equities later on got the memo as well that, hey, the prices component actually came in above 50, around 51. And look, bonds are selling off, higher yields. The yield curve, the U.S. yield curve has also even inverted even more. And then the stock market finally sold off. And after 9:30 a.m., it continued to sell off. You had massive moves up also where you had a bunch of squeezes. And the reason why you saw all this choppiness in the equity markets, first up, first down, make a new low, then move up higher again, is because there's confusion. And like I've been saying over and over again in my previous video, the stock market, the equity traders are in la la land. They have no idea. 50% of the people are saying this is bad. The other 50% saying buy the dip, doesn't matter. Fed's not going to do much. The growth data is weak. So, hey, the price is a little bit hot. So be it. We know that. But we know that, it doesn't mean much. And buy the dip, right? While the other side of the equity traders are saying, no, this is bad. I don't want to own any equities. And you probably either get them not participating, no buyers, or you got the short-term strategic sellers coming out and trading the data. Now, what matters the most, and what I keep telling people, is look at the bond market. The bond market is telling us a very telling sign, and we see the bond market selling off, especially the short end, and you see today the yield curve, the U.S. yield curve, move into more inverted territory where the yield curve is now sitting at a new low of minus 0.9%. This is way deeper than the inversion in 2008. Way deeper than the inversion in 2020, way deeper than the inversion in 2001. We're almost close to negative 1% on that inversion, and it may not be over. We may see continuation of that inversion. We may see, especially on the short end, continuation of sell-off in bond yields, and we can see the 2-year bond yields continue to move up as the short end bond continues to sell off. Now, as those yields move up on the short end, you are seeing somewhat of a pickup also on the long end. The long end is not heavily as affected as the short end because if you think about it, if you get higher rates, then that basically means that should cap inflation, which shouldn't move too much of the long end bonds. Now, the long end bonds still can move up in correlation with the short end, which then again puts back to back more pressure on the mortgages, right? The mortgages that are out there that are linked to the long end. If those yields go up, then sure, those mortgage rates will also continue to go up and create more pain for more consumers out there. So we're seeing already from this data, and we got more data this week, we got more data next week also, we got the jobs data, and we got inflation data, and then we got the Fed at the end of the month as well, at the end of March. And we still have to see how all this data comes out and whether the prices component that we saw today reflects in the other data points as well, in the other ISM non-manufacturing. And also when we look at average hourly earnings for the jobs component next week. So there's more of a telling sign that tells us that, hey, I don't understand how the markets could be heavily, or majority of the people heavily thinking that we're going to get the soft landing or no landing, when data, forget about the growth data, but when you look at the prices component, still continue to be strong. And we know, and we heard from the Fed, and that gives them more reason for the Fed to continue to be tightening, to continue to keep rates higher for longer. And you're starting to see that in the markets and in the bond market start to price out rate cuts. Before, they were expecting rate cuts to happen at the end of this year. Now you're seeing that being priced out, and you're seeing no rate cuts for this year, and that we peak around 5.5%. Some are expecting 6%. I do also see 6%, a very big possibility. And then kind of peaking there and keeping rates elevated for a long time to create more pain to try to suppress inflation. Now, according to the Taylor rule tells us that we need rates above inflation. Will 6% do it? Or will 5.5% do it? If not, then maybe 6%. And if 6% not, then maybe 6.5, maybe 7%. I would not be surprised if we continue to move up even north of 6%. There's a lot that needs to be done with inflation. We're seeing it all over. You're seeing it in the US. You're seeing it in Europe. You're seeing it in food prices. You're seeing it in many of the components. And when you look at the last CPI report, especially with the Fed coming out, looking at the super core number, saying that, hey, take out the housing component and all the other components that make CPI hotter, the super core component of inflation still came in hotter than expected. So even with the Fed coming up with all kinds of rational, all kinds of numbers saying that, hey, look at there. Okay, no, that number is hot. Okay, look at that number. No, that number is hot. Okay, look at that number. Look, we're kind of bringing inflation down. Yeah, somewhat. It has come down from its peak, but you have not achieved the goal, which is the 2%. Now, some argue that why, do 2%? Why not just do 3% and leave it as that? And the Fed has told us many times that 2% is their goal, and they're not looking to, change their mentality, their goalpost to now 3%. If they do that, that basically shows that they've lost against inflation, and they will have completely lost control on trying to control inflation. Now, this is a very slow pain that we're probably going to experience in the equity markets, in the stock markets, and in the economy. This situation could last for maybe a couple of years, especially at the rate how the Fed is going, right? With when it comes to trying to bring inflation down, they're slowly, inch by inch, trying to raise rates to bring inflation down, and they're not as aggressive as they were last year. Of course, things can change, but if they're slowly inching and raising rates and nothing breaks for the whole year, then this could be a very long, volatile, rangy type of market. And it could take some time. It could take some time, especially if inflation creeps back up and the Fed needs to do more, then they will, maybe hike starting with 50 basis points, maybe more, and then eventually maybe in 2024 we really see the effects, right? But we will know more as we get more data. So let me know what you guys think. Leave a comment below, hit the like button, subscribe, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.